We start strong with James Bianco of Chicago and Bianco Research. No one, and I mean no one got out front on a resilient, sticky inflation like Jim Bianco. Lindsay Piegza did a great job, working at a Wall Street firm like Stifel, saying, we're going to have this persistency of rates. But Jim Bianco was like Columbus coming across the ocean. Jim Bianco joins us now. Jim, you mentioned in your note this morning you still consider inflation sticky. Define sticky.
Something above 2%, which is where it is. Let's use the CPI number. Core is sticking at around 3.3, and the headline number is in the high twos, and that's been pushed down a little bit by low gasoline prices. But if the Fed's target is to get it to 2% or lower, I don't think we're going to get there unless we have a recession that kills demand and brings it down. So its natural rate is going to be something like 3%, and that's what I define as sticky.
I get the idea they want to get back to what they knew before. There's a comfortable idea there. But if you have nominal GDP, productivity, the technology overlay, and the Chicago Cubs ascendant, the answer is you get a persistency of growth. Is that what you modeled, Jim Bianco?
That's exactly right. You're looking at an economy at a nominal growth rate. That's the real growth plus inflation, running at around 5%. Now, what does that mean? That means that like the neutral normal interest rate you should expect in an economy should be around 5%. I think the problem the Fed has and everybody else is the anchoring bias, that they got so used to zero for such a long period of time that they thought that was normal. That was the abnormal period. A 4, 5, 6% rate is normal right now. But the problem is, if you're in the real estate business and you hear me say 4, 5, or 6% normal, you've just spit your coffee out. But this is the environment we're in right now. We need to accept that this is the environment we're in.
So, Jim, with a sticky inflation, as you call it, and a labor market that seems pretty solid, we'll get some more, obviously, data today at 8:30. What do you think this Federal Reserve should do?
Well, let's talk about what they will do quickly.
Okay.
They held in January. The markets are pricing in a hold in March and a hold in May. So then, we're now looking at potentially the Fed cutting rates by June. I think if they could make it to that point to June without cutting rates, I think we could then turn around and say that the rate cutting cycle ended in December.
Okay.
And that cycle is now over. It was 100 basis points over 3 moves is what they cut. Only if we were to see some deterioration in the economy in the next couple of months would I change that view. So I think they should stop. And the markets are kind of coming around to that view because we've pushed out the next rate cut to June right now with the way we're pricing it.
Stocks, bonds, cash. What do I do in that kind of an environment if the Fed's not cutting?
Yeah, I've called this the 4, 5, 6 market. And what I mean by that is that over the next several years, you should expect cash to return you around 4, as we talked about with interest rates. Bonds have a coupon at around 5 right now. And I think that you could get the coupons around 5%. And stocks, given the high valuation in stocks, Robert Schuller at Yale University won the Nobel Prize in 2013 on his valuation model, saying the higher the valuation, the lower the future returns. I think we're looking at 6% on stocks. Now, that's not bad. That means that bonds will compete with stocks. But I think more importantly, it might be a return to the stock picker capitalism market where you pay a professional investor to find good ideas that beat an index. The problem in the last couple of years was when the index goes up 25% a year, it's really hard for a professional investor to add any value. But in a lower beta environment where the market returns 6, I think we're going to return to stock picking again.
Alpha, beta, gamma, delta. Coming up, Jim Bianco on Epsilon. We welcome all of you on your commute across the nation here on Apple CarPlay, Android Auto, Sirius XM. James Bianco with us in Chicago. Priya Misra to come up here on a jobs day. Zentner and Sam will be with us in the vicinity of the 8:30 mark. Jim Bianco, at the bottom of your note, you do say that active manage. What does active manage equate to? Very narrow sector choices, or you sprinkle it around?
No, I think active managed, is thematic picking. I think it's, stock picking. It's somebody making judgments on this is a good idea, give it money. This is a bad idea, take money away from it. Instead of let's give money to the index and let everything go up, or let's take money away from the index and let everything go down. I think that active management would, enhance the economy even better, because that's the whole point of capitalism, is to reward the winners and punish the losers, and we could get more back to that kind of investing style.
Jim, on the fixed income front, I mean, a lot of folks probably would be pretty comfortable in the Treasury market, 4.25 on the short end, maybe 4.5 on 10-year. Do I stay there, or do I take some credit risk out there?
At this point, if you have to take a risk, if you want to reach for yield, I would rather do it in mortgages. I would rather buy, mortgages that are yielding 5.5 or 6%. Taking the risk. What's the risk in a mortgage? Interest rates plunge, you get refinanced, and then you're handed a bunch of cash at a lower interest rate, as opposed to taking a credit risk right now. Credit spreads, corporate bond spreads, look a lot like stocks. They're fully valued, if not overvalued. And I'd rather take that risk in mortgages. And if I wanted to play in credit, I'd probably move further up what we refer to as the capital stack and probably buy bank loans.
Jim, we're kind of right smack in the middle of earnings season. Any takeaways for you? It seems like it's kind of been, mixed at best.
Yeah, that's a good way to put it. I do think it has been mixed. Right now, there's been this big obsession over the Mag 7 companies, and rightfully so because of their dominance. But when you take them away, I think it's been kind of a fairly middling type of earnings season right now, which is kind of what you should expect in this type of environment.
I look, Jim, at where we are. Let's call it early 2025. You've been so good. You mentioned single-digit equity return there. Does GDP sustain past 4th of July? Do you have not a lumpiness, but a diminishment or lessening of nominal or real GDP out into this year?
No, I think it can. I think it can stay, where, the inflation rate churns out, in the high 2s, low 3s, and the GDP rate churns out into the 2.5 range, and that gives you that 5 real. And I think that can churn out. Now, what I didn't mention, I should mention now, is I am in the camp that this is a K-shaped economy. I've talked about the top line. K-shaped meaning if you're in the bottom half of income, that 3% inflation rate can be a problem for you, because unless you're getting a 3% raise, everything's going to be 3% ish more expensive, whether it's your rent or your food or everything else. Where the top end, they'll own stocks, they'll own real estate, and that will at least go up by that much and help cushion those higher prices for them.
For Global Wall Street, Priya Misra with us here to get us out to about 40 minutes. Jim Bianco with us right now to have Bianco and Misra to get us started as the way we roll today. I look at the real yield as the Global Wall Street metric. I'm using the 10-year. Jim, I know you use something more sophisticated, but the observation I have is it's come down over the last week or 2 weeks. It was a 220. All of a sudden, I'm printing 199 for a cup of Sanka. Here, what is the significance of a lower inflation-adjusted yield?
Well, I think if we look at where the real yield is in general, is you're right, 2% to 220 on the 10-year yield, and of course that's the 10-year yield minus inflation. People have looked at that and said, that's roughly in the range of a 15-year high. But I'll go back to what I said earlier. Watch that 2010 to 2022 period and think about that as being the abnormal period when we had zero and negative interest rates. And if you were to look at real yield, say from the 1970s to 2008, they averaged 2.5%. So a 2%, 220 real yield right now is about average for a period where we don't have zero negative interest rates and quantitative easing. We actually have quantitative tightening right now. So that's part of the bigger mosaic that I'm trying to say. This is normal, what we're seeing right now, where everybody is really trying to paint this as high interest rates, maybe being restrictive. Jay Powell talked about that last week, that interest rates are still restrictive. Right. And what I'm trying to say is, no, they're not. This is actually normal.
Well, in our Ute, when the Cubs won, 4.1% was a miracle unemployment rate. I mean, is it as good as it gets, frankly?
I think so. I also think that the unemployment rate has got some kind of an issue trying to measure it.
Because of the population and immigration.
Right. The unemployment rate is a measure of the population, a certain thing that they're doing, whether they're employed or not employed. Well, the population has exploded higher in the last 4 years, and therefore it makes anything related to measuring the population a little bit more difficult. So I think that the unemployment rate is going to be harder to measure. But that said, I think you're right that we're at levels of historically low unemployment or high levels of employment, and I think we're going to stay there. And that fits into that idea that the economy, just at least at the top line, continues to churn about.
Jim, the U.S. dollar's had quite a run since late September, up 6-7% here. What's your view of the dollar and how it might just impact these markets?
What the dollar seems to move in lockstep with is U.S. interest rates. When U.S. interest rates go up, the dollar strengthens. When they go down, it weakens. Now, it doesn't always do that, but it's doing that right now. And that makes sense because it's the interest rate differential between us and another country that really drives a primary driver of the dollar's level. But I also think that what was baked into the dollar over the last month or two was this idea that we were going to see tariffs. Because if you see tariffs, the response of the country getting tariffed, like Canada, Mexico, or China, is to devalue their currency or have the dollar go up. Well, we had tariffs at the beginning of the week. I know it feels like 2 months ago, and the president cut a deal to delay them for 30 days. And I think that some of that extra dollar strength that we saw on the fear of tariffs might be coming out of it. And I would see kind of it continuing to drift lower, even if interest rates stay at this level.
Jim Bianco, thank you for getting us started on this jobs day. Just really great to get a good summary there. And again, folks, he's been lights out on sticky inflation. There's no other way to put it. Futures are flat.